Hi everyone, so welcome back to our lessons on fiscal and monetary policies. Um, Hope you're fine, right? Hope you enjoyed the last class on fiscal policy. So today we'll continue with monetary, or we start with monetary policy. So what exactly is monetary policy? Could you mind reminding us? I like that because I defined it in the last lesson. Cool, yeah, amazing. Yeah, so monetary policy is a type. Did I just hear you say when? It's not when. Okay, it's a type of macroeconomic policy. Um, that's what am I supposed to say? Okay, it's a type of macroeconomic policy that is spearheaded by the CBN um, in regulating economic activities through the usage of interest rates and money supply. So through the usage of interest rates and money supply, so like majorly. Now, um, just like fiscal policy, where we add tools, fiscal policy tools or fiscal policy instruments, fiscal policy measures. So what are those things? Just tax, and government spending. So it could be direct tax, be indirect tax, at least it is tax, and then government spending, subsidy, infrastructural spending, higher salaries, everything is still talking about government spending. So they are just two basic tools. All right. So coming back to monetary policies, there are a number of tools that the CBN uses to regulate economic activities. Okay, so what are those tools? Of course, the tools that they use, monetary policy tools, tools of monetary policy or instruments of monetary policy. So number one, you have the interest rate. Interest rate. Number two, you have the monetary policy rate. Monetary policy rate. Number three, you have the discount rate. Discount rate. Number four, you have the cash reserve ratio. Cash reserve ratio. Number five, you have liquidity ratio. Liquidity ratio. Number six, you have moral suasion. Number seven, you have special directives. Number eight, nine, and 10, you have, don't worry, etc. Alright, so it's like, the central bank figures are problematic. When I was learning about fiscal policies, so just to tax and government spending, so simple. Okay, well, so there are other instruments that I probably don't even know about. At least you have, these guys. Yeah, so interest rates, just talking about the percentage of returns that must be made on a loan. So the percentage of returns that must be, made or paid, okay, should be paid. Percentage of returns that must be paid, um, from taking a loan or on a loan. Do you understand? So how can interest rates be used? So central bank could just, tell banks to raise their interest rates. Just do something that will make them to raise their interest rates. And how does that actually work? Because it now depends on whether you're going to be having an expansionary um, monetary policy or a contractionary monetary policy. So for each of them, for expansionary monetary policy, so the government, the central bank, the government actually through the central bank or the Federal Reserve Bank, like they have in India and then I think the US, Nigeria has central bank. So um, for expansionary monetary policy, so they are going to be manipulating any of these tools, any one or more of these tools at the same time, to increase money supply in order to boost economic activities. You get it? Now, but in periods of contractionary monetary policies, they are going to manipulate some of these things, right, in order to like reduce money in circulation, right, during a given period of time, depending on whatever the goal, the macroeconomic goal is or are at that particular period of time. So if the banks, commercial banks now are raising interest rates, what is going to happen? Now you see, you have savers, you have savers, you have investors, and then you have the big boy in between. You have the bank serving as intermediary between the two of them. So the bank will cash out from savers, lend money to investors. So the bank can give this guy 3%, no, let's say 8%. And when you deposit money, so you're a saver, so you deposit by 1 million. So the bank can give 8% on that. That 1 million, not all of it anyways, right? But to keep things simple, they lend it to Mr. Joe, who is an investor, but they lend it to him at let's say 22%. So what's going to be the difference? Difference of 14%, right? Is the reward of the bank. And lending is risky. And you that deposited your money, you can come and demand for your money at any given period of time. So the banks must ensure that they can give you your money back no matter the time that you are looking for it, and still ensuring that they lend it out to people that want to use it to like do great things, invest in the economy, right? So what is happening here? This 14% represents arbitrage. So like the difference in interest rates, between the ones that banks charge investors and the one that they pay savers. So if you keep your money in fixed deposit accounts, that interest that they give you, right? So that's what is happening here. So and the fact that you kept your money in fixed deposit account for a period of time, it gives the bank the ability to lend that money out. It's not as if because you kept it there, the money sits there. No, you can lend the money out. So you're keeping it for 1 year, so you can lend it out for like 6 months or 9 months, knowing that the money is going to come back and then that they'll be able to pay you after a year. Do you understand that kind of a thing? So this is what is happening. But for banks to be able to like okay, to lend money, they pay you this interest rate, then they charge this interest rate. So in periods of if you are in an expansionary monetary period, where the central bank's goal is to put a lot of money in circulation, so what they are going to do is that they will reduce interest rates. So they reduce interest like they reduce it to like 5%, and of course these people can begin to charge them like 11% instead of 22%. Now this thing it works in two ways. Now savers would be discouraged. Some savers will be discouraged from saving because if you look at it, and let's even say 2%. Even say 2%. You'd be like really discouraged, like 2%. Like I should keep my money with you for 1 year and I'm going to be getting 2%. How does that even make sense? It's just better for me to go and spend my money. So you spend. And that was their goal. They wanted you to spend, so you spend. Do you get it? Now, for investors, they've reduced the interest from 22% to 11. You look at it, okay, wow, it's actually cheaper to take loans now. So you can't take loans that you to spend as a business, in um, coming up with establishing your business, expanding your business. Everybody's spending, and that's is the goal. Like they want you guys to spend, right? So this is not going to work in situations where there is okay, yeah, don't let me bring in something else. Yeah, so yeah, you have this, right? So yeah, this is not going to work actually in situations where you're experiencing what we call liquidity trap. Liquidity trap. So liquidity trap represents a period in an economy where interest rates are already so low that reducing the interest rate still do not translate into stimulation of the economy. So your interest is already low. So maybe interest rate is 1%. Then you now reduce interest like 0.5% or 0.2%. Like doesn't do anything, right? So we see that you cannot monetary policy is not going to be effective in that kind of situation because you can't manipulate interest. People are not responding. The economy is not responding to like lower interest anymore because it's already so low that reducing it again doesn't make any sense. So your economy is experiencing liquidity trap. But if there's no liquidity trap, this is going to work. Investors spend, consumers spend, that is it. Now the opposite is what happens in during a contractionary monetary policy period. So what the banks would do is to raise this 8% to like 15%, raise this one this percent here to like 31%. And so you look at it as a consumer, as a saver, a depositor, you're like, oh, it makes sense to save money now. 15%, oh wow, that's interesting. Let me go and save my money. After all, I don't really need it. Okay, you go, you save your money. So you spend less. So that's contraction and money is being taken away from the economy. That's what the central bank wanted. So money is being taken away from the economy. Now for this other one, 31%, oh, investors will just cool down. No, 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 no. So they take less investments. Only the ones that are really sure of themselves are the risky ones who can't take on investment. So investment reduces, right? Consumers reduce their spending, so they save more. Investment falls, consumers. It doesn't happen like that to everybody, but like to the majority of the people in the economy, right? So they respond that way. So when people are saving more, they are taking money that they should have spent to the bank. Investors are not taking money from the bank. In fact, they are even taking less now. Do you understand? So money is taken away from the economy that way, and then the economy contracts. Do you understand? So you get the way it is going now. So economic activities reduce, calm down. So like that is how that one works. Now monetary policy rates. I need to explain this because I figure that students still like mix things up. It's easy, right? But then it's what it is. Now for number two, monetary policy rate. So this is the rate that determines other interest rates in the economy. So it is a leading interest rate. It's not as if they need it to be borrowing money. Nobody lends you money or whatever. You understand? So when you read that monetary policy committee wants to meet, I think they meet every 3 months in Nigeria or thereabouts. So they meet, talk about the state of the economy, how they inform people, economists, all of that. They come, they talk about the whole thing, and then they're like, we think that we should pursue, there should be more money circulation for people to do business. Okay. So initially, the monetary policy rate, which is the leading interest rate, is like, let's say, 27%. So when they meet, the outcome of the meeting could be that, oh, guys, this has been reduced to 15.4%. So what this means is that all commercial banks, whatever interest you're charging, reduce it. So that's what it is. So monetary policy rate is the leading interest rate in an economy. So if it is lowered, so it sends a signal to the banks, to the commercial banks, that lower your interest rates on loans that you are charging investors and that you are giving savers. And if the monetary policy rate is increased, so it is just there to send message to the banking industry, right, on the line of action to take. So for contractionary period, you just see that this has been increased, others will increase their interest rates. So, for example, where the monetary policy rate was 27%, Zenith Bank, for example, may be charging 29.5% on its customers. But now that they've reduced to 15.4, Zenith Bank will decide to begin to charge like 17.6%, whatever. Do you understand? So it just sends a signal to the entire banking sector on what to do. Now, the discount rate, um, you know, the central bank is known as as how does it President's Bank, is known as the government's bank or banker's bank. So you can't go there. I cannot go there as an individual to go and borrow money. Do you understand? They're not going to. It doesn't even make sense. You're not going to go right. But the thing is, when commercial banks are balancing their books, and maybe they need cash or something, so they approach themselves. So like Zenith could approach GT, GT could approach Access, like just borrow me money, like just lend me money, like overnight or thereabout. They may be like, we can't lend you money. So if commercial banks have tried, right, and they can't get, so they approach the CBN. Okay, see, just lend us some money. You just need the money, like very quickly balance something they're going to give you back. So the interest rate that central bank charges on overnight lending to commercial banks, what we call the discount rate. So it's also an interest rate. So this interest rate sounds like listen, so it's also an interest, but the purpose is different. So if you're researching, you want to learn about discount rate in this form. So you Google it, discount rate in banking. So it's going to tell you this, that is the overnight, interest rate that the central bank charges commercial banks for borrowing from it. So, and of course, if the central bank is charging a high interest rate, I know that that's going to have a what do you call it now, a ripple effect on what the commercial banks will charge investors and charge savers. You get, so it's still interest rate, but just for a different purpose. Now for cash reserve ratio, now this I should spend time explaining the cash reserve ratio as well. So cash reserve ratio is just the ratio that determines the amount of cash that commercial banks must keep with the central bank. So the cash reserve ratio, the CRR, determines the amount of cash that the central bank, that the commercial banks must keep with the central bank. So let's say in Nigeria, the cash reserve ratio is 30%. Now I was telling you, if you remember, I said that this is not that simple. Do you get it? Now, let's say there's this is one of our spend now. Let's say there's Afusat. So Afusat came to UBA with 1 million, so she dropped 1 million. Out of this 1 million, 30% of it must go to the CBN if the cash reserve ratio is 30%. So which means that UBA must pay 300k to the central bank. UBA must pay 300k to the central bank. So UBA is going to have just 700k to lend out because the cash reserve ratio is 30%. So it's a reserve. It is a ratio. The cash reserve ratio is ratio that determines the amount of cash that commercial banks must keep with the central bank. So if you are in a contractionary monetary period, the central bank doesn't want a lot of economic activities. Okay, what's that supposed to incapacitate commercial banks? How? If it wants to use cash reserve ratio, just say, guys, yeah, this is what we're doing now. So cash reserve ratio now is 45%. So which means that if someone is depositing 1 million, 450,000 must go to the commercial, must go to the central bank. So which means that unlike before, where you had 700,000 to lend to investors, so now you have 450,000 to lend to investors. So they've reduced the amount of money that you can lend out to investors. And what is that going to do? Commercial banks would have to raise interest rate because the amount of money that we can lend now is not as much as what we used to lend before. Okay, so they will charge higher interest. So if you are mighty and you can come and take the loan, and then come. But a lot of people are going to withdraw like, when I take loan of 45%, I've not even made profits. How much profit am I exactly going to make? Will I be able to repay the loan? Maybe just, and that is what the central bank wants. Do you get it? So the other way around, expansionary period. So here, central bank would have like lower the cash reserve ratio. So okay, most of your money should be with you. So the central bank will say, okay, cash reserve ratio is now 10%. So which means there's an individual who brought 1 million, only 100K is going to what? To the CBN. So you have 900K to lend out. Again, it is not that simple, but just like make you understand at least the basics, of the whole thing, right? So, especially monetary period, the central bank would have to lower cash reserve ratio. So you take take a smaller amount of the amount of money that commercial banks kept with you before. So be taking a lower amount. So when you were taking 300K before, so you're now 100K. So you take your now 100K. So as a lot of people are depositing money with commercial banks, central bank is taking less than it used to take before. Commercial banks have more money to deal with, more money to lend out. And if you have, there are a lot of banks, then they have a lot of money to deal with. I can't do shakara for you now as a bank manager because if Zenith is saying, okay, we can't lend you money anything below 35%, I can approach UBA, I can approach GT, I can approach Access because there's money now, right? Central bank has, made that possible. So I can always get a lower interest rate somewhere. Maybe not too low, but I can get something more reasonable. Do you understand? The interest rate will be forced to be reduced during that period if things go well. So yeah, liquidity ratio. So this one is similar to the cash reserve ratio, but it's different in the sense that liquidity ratio determines the amount of cash available with banks in order to sort out short-term cash obligations. In order to sort out short-term cash obligations without having to sell their long-term assets. So which means that out of every money deposited with commercial banks, do you understand? So a percentage of it must be saved as cash because they have to be loading the ATMs, right? The automated teller machines with cash. So a percentage of it has to be saved with them as cash, which they can use to like fulfill those short term, cash, transact, keep things flowing. And then it's also like save you from a bank run. So when people are learning, bank run is a situation where a lot of people are withdrawing because they had something bad, something negative about a particular bank. So to save you, when somebody says, "Oh, the CEO of Access Bank has died," and then people are thinking that, oh, because of that, they are going to lose their money. A lot of people are going there to withdraw. So the ability of Access Bank at that point to withstand whatever whatever force of withdrawal that people are, mounting on the bank, then would be determined by their liquidity ratio. So how much cash are they been able to keep? So when people are learning that this bank, they thought it was going to fail, but everyone that is going to the bank to withdraw, they're able to get their money. Everyone that's going there, you understand? At the point, people just calm down, like, oh, the bank is not failing after all, because if it was failing, I shouldn't have been able to withdraw. So they calm down, you know, the chaos that would have, happened just because they had, a sustainable liquidity ratio that kept an amount of cash available for them to always fulfill short-term financial obligations, but and not resorting to selling long-term financial assets. You get it? So liquidity ratio in a period of contractionary monetary policy increase it so that banks keep more cash, so that they must not lend. Do you understand? So they must not lend. And in terms of expansionary policy, banks keep less cash than they must lend. You understand? So it looks like counterintuitive, but we are just saying that the way banks create money, the way banks put money into the economy is through lending money to investors. That's how banks create money. That's how commercial banks create money. It's through lending. It is through this process that I've said here. That's how they create money. There's a class on that, how banks create money. Do you understand? So if you want banks that make more money available in the economy, you create more loanable funds. Do you understand? More money that they can loan out. But if you're asking banks that you must keep 20% of your cash as in liquid form, you must, and maybe banks were keeping 5% before. They are not saying you must keep 20%. And remember that there's still cash reserve ratio. So I remove all of those things. And so what banks, the loanable funds that banks now have to lend out is lower compared to what it is. It's what it used to be. You get it now. Now for moral suasion, this one is central bank appealing to commercial banks. Please now, please lend money to people. So commercial banks may not be confident in lending money to people because they have a lot of bad debt. Like they've lent money to people that the money don't come back. and there are a lot of court cases, carrying one chairman, one CEO, one that to the court, and then they are still not able to recover their money. So like they may be like really discouraged to like lend money out to investors. So central bank will now be appealing to commercial, please, we can you might be able to like walk around it, maybe like bail you out or something, but at least lend money out, push money into the circulation into circulation. So if that's where they want more money to be in circulation. And if the reverse is the case, then moral suasion, if they appeal to them, please don't be appealing, don't put money in circulation. Appealing to get that kind of a thing. So then the last one is special directive, which is the opposite of moral suasion. So for special directive, it is an order or an instruction that must be obeyed. Now, for example, during Buhari, the late president's regime, um, he did something and said, okay, the CBN, they just people should not be able to withdraw more than maybe like 5,000 or 20,000 from their account for like from the POS or from the account, I think on a daily basis, because they wanted to like push the narrative of cashless policy. They wanted to like reduce rigging, during election. It had a lot of political undertones, but then it wasn't effective. So that kind of a thing though is special directive. So like banks must comply. So if you're told that nobody must be able to withdraw more than 20K on a daily basis, or nobody must be able to transfer more than money on a daily, that's a special directive. So if the directive is like in such a way that doesn't allow people to like transact as freely as they used to be before, then that means that it's going to be a contractional monetary policy. And then if it was something that would allow more money to be available, like maybe central bank instructing banks to have more ATM stands in rural areas. Do you understand? Because if you have more ATM, you have to load them with cash now, so that people in rural will be able to access cash and do business. So that's going to be a special directive that is expansionary in nature. All right. So with the fact, I hope that I've been able to like explain how these policies work in such a way that from this single class you're going to understand, or you've understood it a lot. So you can leave your questions in the comment section. Uh, is there an assignment? So there should be an assignment. Um, so yeah, your assignment is, I didn't talk about one of them. Write short notes on quantitative easing. Write short notes. So assignment, write short note on this thing. Like quantitative reasoning. For this one is quantitative easing, to make things easy. Write short note on quantitative easing. Then number two, the second assignment is going to be discuss whether or not the use of monetary policy will increase economic growth. Discuss whether or not the use of monetary policy will increase economic growth. All right, so this one is 8 marks. Then this guy is 2 marks. So now, as an economist, or as an economist in making, you must be able to talk on from both sides of the mouth. So what this is just trying to like, second one is trying to like let you know is that in what situations would monetary policy be effective, in what situation would it not be effective. So because the instruction says discuss whether or not, it means that you must speak from both sides. So you must not just speak on the strengths of monetary policies or on the weakness of monetary policy alone. You must talk about some strengths, some weaknesses. So you may do 3 strengths, 1 weakness, you do 3 weaknesses, 1 strength, 2 strengths, 2 weaknesses, but at least make sure that your argument contains both strengths and weaknesses. So you get it. So that's about that. Thank you very much. I'm tired. Right, I hope you enjoyed the class anyway. See you when I see you again. Have fun. Enjoy the rest of the day.